This is Satya Pradyuman of Cirrus Research. The latest signals report is just out. The title, The 50% Problem. The US tech sector is now half the US market. And this was before SpaceX became public. So what this chart relates is over time, the performance of the US large cap technology sector against the US market. The relative performance is the line curve. And in addition to that, what we've stapled in these exhibits are the weights of the technology sector. For instance, at the bottom of a bear market, let's say back in 2001, 2002, where the US technology sector was about 12.5%. We've also seen it escalate through, let's say, the initial hit with the pandemic, where we became at home. And as a result, we saw the technology exposures really spiral up to about almost 33%. We saw the pullback with the Fed tightening, and then since then we've had the AI trade. The reading, as we see it now, is about 45.5% as of this past month end. Bottom line, portfolio managers, chief risk officers, CIOs are going to struggle with this. They're delivering active, diversified portfolios, and along comes this moment with AI and the technology weightings, where it's effectively half the portfolio. How does this change? How does this change with SpaceX coming public? Do we see some sort of a crowding out effect? Bottom line, though, the volatility in the sector is going to remain quite high because the stakes are so high. In addition to that, markets have a wonderful way of being very efficient. So for the firms that are bringing in all the growth, what we're now seeing is the relative valuation in our style oscillator. That's whether we continue to lean to growth stocks or lean away from growth stocks, become more valuation sensitive, be more value invested. What this reading is now saying and hailing is that we're now an overweight on value. So hard to stomach, given all of the excitement around the AI tools, how things are rolling out, and the spending that's likely to hit the sector. That said, the question, what this is suggesting is that investors have really acted with their money. And as a result, the sort of extreme boundaries that we're seeing, they're sort of getting hit. And as a result, this is why we're seeing this sort of lean or overweight value reading. The final exhibit out of the full report that I think is worth capturing is that in the fall of last year, we really flagged that the speculation in the US had gotten to such levels that we had not seen really since 1999, 2000. We saw the massive pullback as markets really spiraled backwards, and we saw speculation levels hit more benign levels. What we've seen in just a few months, 2-3 months now, is these numbers have really ratcheted back. So we're slightly shy of the one standard deviation boundary. This does get us to sort of say, as investors race back into the space and start taking on more risk, at some point, these readings are going to get to some extreme, and then it does force us to then begin to lock down, become a little bit more defensive in the portfolio. Take a look at the full report, and as always, happy to take your questions. Thank you.